In the beginner's course, we identified and traded ranging markets. We use specific tools to help us identify the accumulation phase. Now the next market state we will trade is the trending market. So after the market has finished its accumulation phase, it will typically break out of that range into an uptrend or a downtrend, unless the apparent breakout was not a breakout, instead a fake out. So in the case of a fake out, the market will most likely go back into the range, finish its job there, accumulate more stop loss orders on either side of the range before finally breaking out into the true uptrend or downtrend. In order to trade this next stage, we will make use of a different set of tools. We will use Heiken-Ashi candles together with traditional candlesticks. Now there are subtle differences between the two candlesticks. With the traditional candlestick, we have the open price and the closing price and a high and a low printed on the chart. And each of these candlesticks has no relation to the previous one. So it's independent. Heiken-Ashi candles are, however, calculated and plotted differently, using a different formula. It uses information from the previous candle, so it's dependent on the previous candle. The Heikin-Ashi formula is not of utmost importance to us, but for interest's sake, the close is the average price of the current bar and the open is the midpoint of the previous bar. Now, as I said, it is the result of this calculation that we should focus on and not the formula. It results in a smooth price action. The movement appears much smoother. Therefore, the trends and trend lines and trend changes can more easily be identified. Heikin-Ashi means average bar in Japanese. So with this strategy, we're going to use both Heikin-Ashi candles together with the traditional candlesticks, because the apparent advantage is also seen as a disadvantage to some price action traders. The smoothing of the trends comes at a cost of hiding the noise. And the noise is what we look for on the 15-minute chart for our trigger. The noise is the manipulation at play, so it will be a disadvantage for hiding this noise. Therefore, after identifying the trend, we drop down to the lower time frame and zoom in closer on that 15-minute trigger chart with the use of our traditional candle. So any disadvantages that are commonly associated with Heikin-Ashi candles are not considered. The fact that Heikin-Ashi makes it difficult to identify price action is a non-starter in the strategy, because we have the choice now to change back to the traditional candles when it comes to pulling the trigger. So this strategy is very powerful in trending markets with high volatility. We will make use of both candlestick types, and we will take the advantages that both of these candlesticks has to offer.